This episode is brought to you by Persona. In fintech, one bad actor slipping through onboarding can cost you way more than a lost conversion. It can cost you your compliance standing. Persona gives you the identity verification infrastructure to catch fraud early, stay compliant, and still convert legitimate users without building it yourself. Fintech Takes listeners can claim a free year of access at withpersona.com/FTT. Hello, and welcome back to the Fintech Takes podcast. Today, I have a great episode for you. I was lucky enough to have Mike Hsu, former Acting Comptroller of the currency, come back on the Fintech Takes podcast. Mike has been a guest before. He and I have gotten the chance to speak a number of times over the years, and truly I have found him to be one of the most thoughtful people working in all of financial services, and certainly within the field of financial services regulation. In this particular case, I wanted to have Mike on because in addition to being a close student of what's happening in financial services today, he also may become the official Fintech Takes banking history correspondent. He has read, it feels like, every single book on the history of the US financial system and really understands the historical roots of a lot of the things that we're talking about and struggling with today. Most notably, stablecoins, which is a topic that I've spent a lot of time trying to understand, writing about from different perspectives, podcasting from different perspectives, and yet I've never dug into the historical roots behind stablecoins and sort of where this idea came from and the lineage of the idea of stablecoins. So today's episode is one that basically traces the historical roots of stablecoins from free banking all the way to Terra Luna. The goal of the episode, and what I think Mike does a great job of illustrating, is why regulators and policymakers think the way they do about emerging technologies, and how that thinking is shaped by what has come before, and what that means for an industry that's trying to innovate, and at times trying to innovate responsibly. It was a great conversation. We had lots of fun divergences through many periods of US history, which as a former social studies teacher, I really enjoyed on a personal level. As always, it was a delight to talk to Mike, and I can't wait for you to listen to the conversation. So here we go, my conversation with Mike Hsu. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Mike, thanks so much for joining me.
Thanks so much for having me back.
Delighted to have you back, sir. You and I just spent some time in person in Fargo of North Dakota, of all places. Fargo, North Dakota for the Bank of North Dakota's recent fintech and stablecoin event. Surprisingly great conversations, and was definitely a very valuable use of my time. And in particular, I was delighted to get to sit in on a session that you conducted where you sort of talked about the policymakers' perspective on stablecoins. And it was a 90-minute session, which you did seemingly with no notes just off the top of your head. So it was quite something to witness, talking to a group full of bankers. And there was a portion of your presentation where I was like, I'll be honest, I wanted to jump in. I was like, oh, I have a question. I want to do this. And I didn't want to because I didn't want to like totally throw off the session. It was for the bankers in the room. It wasn't for me. But selfishly, I was like, could I have you come back on the podcast and make it an interactive version of that talk? Because it was great. And
thank you.
In particular, there was a portion that you talked about where you spent some time on the historical roots of what we now sort of think of as stablecoins. And I guess to start off with, I'd love to just get your thoughts on why like history and the historical roots of things that we deal with today are important to you, and why you think they're important to policymakers more generally.
So I think at a really, really high level, and I think you had told me this, there's nothing really new under the sun. Like a lot of these things are kind of variants and repeats of the past, but more practically, and I know a lot of the bankers we were talking to, like one of the questions is like, why do regulators do what they do? Why do they think the way they think? Mm-hmm. And history can shed a lot of light on that. And it's not necessarily that, examiners or regulators are historians. It's because history informs what gets adopted, and all of that gets embedded into the DNA and the patterns and the habits. So it's for the mathematicians, like regulation is not a Markov process. Like it's very path dependent. Like everything is path dependent. It comes from what came in the past. And if you understand that history, it's like, oh, that's why. That's why they have a reaction to X or a reaction to Y, because of this thing that happened a long time ago. And that can help. It also provides a little bit of a sense of like pace. I mean, we're going to talk through some things that happened like a really long time ago. And each event that we're talking about, the gap gets shorter and shorter and shorter. And I think that the sense that things are moving faster is because of that. And we're all trying to figure out what happens next. And sometimes I think history helps to frame what's possible, what's likely. And it's just fun.
I agree. I mean, I was going to be a social studies teacher. That's what I went to college for. So I probably was predisposed to find this particular part of your presentation especially interesting. But I do think you're right. And I think it's actually something you told me once, which is that idea of like almost genetic memory getting passed down from a supervisory perspective, where it's like, sometimes you won't even know why you're reacting so positively or negatively to something, but it's because the person who trained you in the job was trained by someone who was trained by someone who witnessed something happen, and it imprinted a lesson on them that gets passed down. And so understanding the lineage of these ideas seems so important to me. So let's do that as it relates to stablecoins. And we are going to start very far in the past. We're going to start, I think it's fair to say, obviously pre-OCC, and in fact, in the era that kind of produced the OCC. So tell us a little bit about free banking.
Okay. So free banking was the period before the Civil War in the US, where the banking system consisted entirely of state-chartered banks, and the monetary system consisted entirely of notes issued by those state-chartered banks. And there's a great book called Banknotes in Shin Plasters by Joshua Greenberg. And shin plasters, don't ask me what they are. They're basically a form of trade credit.
Okay.
But it really paints the picture of what life was like back then. And I think you have to imagine there was the Bank of Alex, there's the Bank of Mike, there's the Bank of Kia, and each of us issued our own dollar bills. And those dollar bills look different. Mine might have been rectangular and blue. Yours would have been square and red. There are all these different designs. And if you go to, people collect these things. They're actually pretty fun to collect. But they all were meant to represent the same dollar. And this was very confusing because you walk around and you would pay and be paid in all of these different notes from different banks. And what made them money is that you could go to the bank and redeem it. The whole point is it was a redemption-based currency. You could go to the bank and redeem it for specie, for gold or silver. Here's my $10. I want $10 worth of gold or silver. And one of the problems is that some of the banks were like, sure, here you go. And some of the banks didn't have the gold and silver.
I remember reading stories about like some banks, they'd be like, oh, it's in this box. And you'd pick up the box and it sounded like there was gold in it. But then you open the box and it was like glass or nails or like literally like things that were meant to like fool you into thinking reserves were there when they weren't.
Yeah. And, and there was this whole group of like wildcat banks. They call them wildcat banks because the bank's address would be kind of in the middle of nowhere, like wildcat country. Yeah. And if you wanted to redeem the note, you're like, where is this bank? And you'd be wandering off in the woods trying to find it. It didn't really examine. So that was, like a scam back then. And because of this, you had to have a lot of information about if I'm getting paid in this square red looking note, is this really worth $1 or not? Or is this not? And so Greenberg's interesting point in his book is that people got very smart about money. Like you couldn't be a noob and you just get ripped off all the time. Totally. So there was a lot of literacy around this. You had these trade sheets, Thompson's Reporter, which would list like 100 banks and what discount to par their banknotes were trading at. That way you knew, oh, I've got a Bank of Mike note. Like that's like 90 cents on the dollar.
Right.
Not a full dollar.
Yeah.
And they had a lot of news on bank runs and things like that. So, it's a redemption-based system, a lot of different issuers, information asymmetries, and you had money changers. And meaning folks would go town to town and they would have these bags full of notes because they would know these notes would accumulate in funny places. Like in South Carolina, you're a farmer and you end up with a lot of these New York banknotes. You're like,
Sure.
I don't know what these are worth.
Yeah.
Like I want South Carolina banknotes. And so these money changers would go up and down the coast and they would exchange. And they were basically exchanges for these notes. And that's what made the money, quote unquote, interoperable, was these money changers. And it was a physical process. And merchants, of course, did some of that just like they do today. And when you step back and look at all of that, you're like, oh, there's some similarities here. You've got issuers, you've got redemption-based money, you've got different issuers, you got things that trade off of par. You've got money changers. And that system, it worked kind of well enough pre-Civil War. But then once you got to the Civil War, Abraham Lincoln had a problem. He had to fund the Civil War. And this system was prone to runs. It was a bit rickety. And it definitely was not able to raise the funds to fund the Union Army. So great book, Ways and Means by Lowenstein, talks about how Salmon Chase, Secretary of Treasury of the Union, he's like, how am I going to fund the Union Army? And so two advances, National Currency Act, National Bank Act, there's going to be a unified greenback, one currency, the dollar, the greenback for the whole, and there's going to be a national banking system that issues these notes and they purchase treasuries. So it's like almost like a narrow bank in a sense for the currency. And that was going to fund the war. And so it was really born out of that need that takes place. And I love the footnote to this. The Congress is like, okay, great. We're now going to, these state issued banknotes, they need to go away.
Yeah. Mm-hmm.
And they do it through a taxing mechanism. So they tax them.
Interesting.
So there's a 10% tax on them and they decline. And I think the assumption at the time was that state banks would kind of close shop, but they got quite innovative. And the state banks were like, well, if we can't issue these notes, what if we created this thing called a checking account? And what if we created checks? So the whole checking system was an innovation because states were basically taxed out of issuing currency notes, which is fascinating.
My goodness. That is, so that is fascinating on 19 different levels. So just talking through a couple of those and just react to whatever things I mentioned that catch your interest here. One is the reserve thing, right? And I think this notion that you can have a bunch of different currencies. And, you and I think, have both used the analogy recently of like 1,000 flowers blooming in the desert. Like right now, like stablecoins, there's so many different stablecoins. There's, speaking of like one being blue and one being red, like everyone seems to want to brand their own stablecoin, which I think is really fascinating. Like everyone wants to kind of own like the thing. And so you have that. You have this question that I think, and we're going to get to the Genius Act a little later, that the Genius Act tries to sort of bring some standardization to, which is like, what is this stablecoin based on? How are the reserves managed? How do we know that they're being managed well and that it's not a box filled with nails or broken glass behind this thing? So you have that. You have like the Coinbases of the world. So like, correct me if I'm wrong, but like carpetbaggers equal Coinbase is sort of like the analogy here. And that's where the term carpetbagger comes from, which is fascinating by itself. And then, to your last point, this idea of sort of forced innovation based on competition. And we're probably going to talk about this a little later as we get closer to modern times as well. But like, I'm fascinated by the fight over yield-bearing payment stablecoins. And one of the reasons I'm fascinated by it, setting aside the impact on bank deposits and all these other things, is I do think there is this notion that, well, if we can't do this, we can't compete. And it kind of rhymes with what you were describing with state banks being sort of forced out of the currency business. Like, you can't do this. And the constraint of that actually forced them to innovate. And I think about that a lot with payment stablecoins, where it's like, how much utility as an operating account is your payment stablecoin based product providing if it can't win unless you can offer yield to bribe people to sort of hold money in it? And so anyway, like a lot of these things historically seem to rhyme, at least from my vantage point.
Yeah, absolutely. Absolutely. And the one modification I would make to what you said, like I do think like the Thousand Flower stablecoins was broadest right before the crash in 2022.
Yeah.
Because before the 2022 crypto crash, you had really weird stablecoins, like all these algorithmic stablecoins. The title stable was just thrown around this is kind of a marketing term. There was no standardization behind it. And, you had some folks taking it seriously, some folks not, and some issuers playing fast and loose with it. And I think that crash kind of washed out some of the shadier versions of it. And part of the purpose of Genius was to say, okay, we want this to be in a tighter box so that it's more scalable and more reliable, which is intended to give it greater kind of trust and interoperability. And that didn't exist back in free banking. Like there wasn't, maybe at certain state levels, they would adjust these reserve rules. You have all these examiner stories, which are pretty fascinating, but they didn't have a national way to kind of get that. And I think that is a little bit different this time around.
That makes sense. I mean, it's almost the distinction between like wildcat banking versus like sort of semi-decentralized or free banking, right? Like wildcat banking is, we have no idea like what this thing is. It's an algorithmic stablecoin. What is that? Well, it's actually a box of nails that everyone just believes is like worth all the gold that we say we have. And I think you're right. Like that part of the sort of free banking equivalent to stablecoins has sort of been washed out. And the topic of a CBDC might come up in our conversation. Like the analogy to me is what Lincoln did during the Civil War and the creation of like one single currency. That's more equivalent to like, we're going to centralize this down to one. Whereas with stablecoins now, there's less of the wildcat element of it, but there's still like quite a few like better regulated, but like diverse decentralized stablecoins than like one CBDC or one kind of digital currency. Does that seem fair to you?
Yeah. Yep.
Okay. Awesome. So now we'll jump forward in time and we will talk about Eurodollars, which I will admit to being less familiar with. I was familiar with the term at a very high level, but I didn't know the history. So like, where did Eurodollars come from?
Okay. So Eurodollars arise in the 1950s. Okay. So we're basically like 90 years. You go from the National Bank Act, plus 90 years or so. And so it's post-World War II. And the Soviets are, there's a Cold War brewing. And you have Soviet-run entities that are earning dollars, and they need to put them somewhere. But because there's a Cold War, there's sanctions on these Soviet-run entities. So they're in a pickle. And they basically call up a couple banks in London and Paris and say, hey, will you just hold our dollars and keep it outside of the perimeter and the reach of the U.S. authorities? And, to that point, all dollars settled on FedWire in the U.S. All dollars were U.S. origin, so to speak. And this, you can call it an arbitrage. You can call it kind of necessity about the Soviets. And of course, those banks in London and Paris said, sure.
Yeah,
so
business opportunity.
Born, right? That is the Eurodollar. It's a dollar that is outside of the U.S. That generally, it doesn't settle on FedWire. It settles through other means. And they were able to offer yield on it because Reg Q applied in the U.S. It didn't apply abroad. So not only could you hold the dollar abroad, you get yield on it. So that comes back into the conversation. But more importantly, this happens at the same time that the U.S. is an international trade juggernaut. Like everyone wants to trade with the U.S. So trade with the U.S. is going up. And now you have this market for dollars outside the U.S. And so it just parallels. So the reason that the world is the dollar is the world's reserve currency parallels this period of time where you've got the U.S. is the growth engine for the entire world. And you have all this trade done in dollars. And a lot of those dollars are kept abroad. Today, I think latest estimates, like euro dollar market, it's like $10 trillion. It's big.
It's massive. Yeah.
This is not a small market. And there's a great, if you want to, if the real history buffs and nerds, there's a 3-part Odd Lots podcast with Lev Menand, where he kind of goes through this in fantastic detail. It's super, it's a great podcast. So if you want to kind of get into that history there, but that, I think there's some parallels now to stablecoins in the sense that as global e-commerce grows, and we can talk about agentic and AI and stuff, like a lot of that is potentially going to be done through stablecoins, US dollar, et cetera. So there's a rough parallel there, which some folks have kind of called out, but it's interesting.
So that is fascinating. A couple notes on that. One is that it seems as though, and this is the thing about stablecoins that's maybe less discussed, but I'm curious if there's an overlap with kind of the experience with euro dollars, which is like from a US government perspective. Like on the one hand, we sort of like to control our monetary policy, and we want sanctions to be effective, and we don't want people to find ways around them. And like the strength of the US dollar gives us the ability to project soft power around the world. So that's one perspective. The other perspective, though, which is somewhat in tension, and I think sometimes this gets resolved in the same building, the Treasury, right? Like you have different groups of people sort of in tension with each other about different goals. The other goal is, well, we want there to be a very robust market for US dollars. And you see this same tension playing out today with stablecoins where, depending on the policymaker or the politician who you are talking to, they might say, well, stablecoins are great because they really further cement the role of the US dollar in global markets. They sort of strengthen its role as the global reserve currency, drives up demand for US treasuries, on and on and on. And yet at the same time, and I think this has been utterly fascinating to watch with stablecoins, it's actually really hard to write about when I write about stablecoins from this perspective, because I'll be like, well, stablecoins are being used to avoid or soften or step around US sanctions or sort of foreign policy objectives that the US government has. And yet at the same time, like to a consumer or small business owner in Venezuela, like they didn't choose any of this. They just they need a way to conduct business and not have their financial lives be ruined by things that are out of their control. So it sounds like euro dollars probably were sort of a preceding version of a lot of these same debates that we're having today.
They're very similar. Those debates were almost exactly the same. And now to carry it one step even further. So with the euro dollar, in some ways it's this it's not a formally sanctioned thing because it grew up outside of the perimeter, but it did have all these kind of soft power benefits for the US, but those benefits come at a cost. And so during the 2008 crisis and during the European debt crisis, when there's a run on euro dollars abroad, what happens? And so you have these swap lines that get set up between central banks because a foreign bank with dollars can't take it to their local central bank. That central bank does not print dollars.
Right.
And so there needs to be a mechanism to get the dollars to the right place, which is the Fed. And so you have these swap lines. Part of the function of these swap lines is to absorb some of that. Otherwise, the thing falls apart. And that has both, that comes with political risk, some operational risk between central banks, but it does have a benefit. So these, every benefit has a downside. Every downside has a benefit.
Yeah.
They just there's a time inconsistency between when those things are realized, which makes it both interesting and challenging and fun if you're a historian.
Totally. Well, I'm having a ton of fun in this discussion, although it is interesting because it does bring up these parallels. And I think the other thing that's really interesting to kind of wrestle with a bit is the way in which technology upgrades all this stuff, right? So it's like, imagine the friction, good and bad, that exists when we're talking about like dollars stored by foreign banks. And then imagine the digital on-chain instant equivalent of that being stablecoins. And it's interesting because to your point about like when stress happens globally and there's like, a run on US dollars, or there needs to be some sort of balancing out between central banks. I can't imagine that we won't see versions of that play itself out with stablecoins, but much like when we dealt with the spring banking crisis and stuff, like when technology changes, the speed at which all this stuff can happen also changes. And I wonder how much policymakers are thinking about, like, hey, if stablecoins become a massive force, so you said $10 trillion for euro dollars, like if it becomes big on that scale, how does it function and how might it function differently and potentially more risky if it's digital by nature?
Yeah. And so I don't have any answers to that question.
I don't even know if there's a question there. It's just like a thing that is potentially concerning. One thing I wanted to ask you about, we're going to skip forward into like slightly more modern times, but I want to divert for just one quick second because you mentioned Reg Q. And I think the other thing that ties into like the lineage of all of this, kind of from like a yield perspective, is obviously the development of money market funds in the 1970s.
Yes.
And I find that one to be another interesting parallel in some ways to stablecoins. In fact, you see a lot of stablecoin advocates argue that stablecoins aren't a big deal. Yield-bearing stablecoins are not a big deal because we already have money market funds and they're big. And yes, they impacted banking, but they also didn't destroy banks. I think it had an impact on some of the regulations around banks' ability to offer interest and other things. And so curious for your quick take on, like, if we pull the car over for a second in the 1970s, like anything jump out to you there as rhyming with what's happening now?
I mean, there's certainly a lot of rhyming. So a lot of these things just exist along spectrums. Sure. Just to deal with everyday life, we like to put things into clean buckets. Otherwise, life is just too chaotic. But almost everything exists along a spectrum. And you've got the spectrum between money and investment that gets really blurry when you're in that kind of money market fund, short duration bond fund, to a CD, to a money with yield, to a stable coin with yield. Like that all kind of gets mixed up.
Yeah. What's money just held in an operating account and what's an investment that has risk? And like it's a continuum.
Exactly. Mm-hmm. Well, the lawyers would say, no. The lawyers would say there's a fine line, and if you read the fine print, a money fund, you are an equity holder in a fund. You're not a creditor. You're an equity holder in a fund. And the fund is designed to have a par value and blah, 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 blah. But if you lose money, read the fine print. It's like losing money in a mutual fund.
And yet, when this happens, when there's stress, like, wow, suddenly we're going to set up, mechanisms to take care of those people so they don't lose money. That happened, right, in the 70s and 80s.
It happens again and again and again because things that are runnable have externalities that, from a policymaker standpoint, is more than just, you have a lot of innocent casualties from that.
Totally.
Like if people invest their money and they lose their money, that's on them. Like there's no need for the government to get involved with that. That's just investing. And you're seeing this debate right now with private credit where, hey, if there's going to be all these private credit losses, if they're just borne by the investors in private credit, then it's something to watch, but it's not something to get kind of the financial stability machinery excised about. However, where you have kind of runnable liabilities that can then have all sorts of other external effects and have negative impacts on innocent folks who had nothing to do with that, then there's some real fairness and some financial stability questions. And money funds just live in that space constantly.
Totally.
And that's why every time we have, 08, European debt crisis, COVID, there's a facility for a money fund almost every single time. And it's raises a lot of questions. There have been a lot of money fund reform efforts to kind of limit that. And I think they've been pretty successful at kind of narrowing it, but not eliminating it. And there are, I think, the purists who say, hey, we should just get rid of money funds entirely. There's a bunch of academics who say, like, this is a false substitute. We're fooling ourselves because we keep saying this thing is investment, but we keep acting as if it's a dollar liability. Yeah.
It's an FDIC insured savings account. Yeah. Well, and the other aspect to that that's just important, I think, to mention briefly is when you divide the line between money and investment, you should keep payments on one side and off of the other side. And so the theory, I think, is investment. I'm like moving money to this thing. It's going to sit there and I can't really use it actively. We used to draw this distinction more clearly between savings and checking, actually. It's like checking, savings, investment, like different buckets that have different mechanisms for use attached to them. So you have a debit card attached to your checking account. You don't have a debit card attached to your savings account. You certainly don't have a debit card attached to your money market fund. However, we know that there are providers in the space that make a sort of payment operating account type product built on top of a money market fund. And so even those lines between like payments and operating accounts versus savings and investment, they blur for reasonable reasons, right? Like it provides utility to consumers. I see the same conversation happening. I remember I looked a long time ago at a early kind of crypto consumer app that was like, hey, we make it easy to spend your Bitcoin, and it's like, aren't those two things different? Like, shouldn't I not be like able to swipe a debit card and spend my Bitcoin? But these distinctions collapse, particularly when technology enables them to collapse.
Yes. And so, the historian, kind of taking another side tour, Alex, in the 70s, 80s, Minneapolis Fed president at the time, Jerry Corrigan, wrote this piece, Why Are Banks Special? And it's in the banking world, like this is a really important article because he's basically saying like, look, he's asserting banks are special because they serve these particular functions for the economy, the payment system, lending that no other institution does. There are some institutions that they may have a piece of it, but banks are the only institution that do them all at one time, and therefore they deserve special attention and regulation and supervision and all that. And there, I would maybe term it like the our bank special hawks who believe that anytime you put those things together, you need bank-like regulation because otherwise it will end badly. And there are others, I think, who feel like, well, that was back then, but today we have a different technology capabilities that should be able to manage this a bit better. And if that's the case, why use 1980s regulatory technology for something that can deal with that today? And I think this is a legitimate argument, but for the financial historians, they'll say, nothing's different. This time is not different. Blending these things all together is just going to end badly at some point in the future. And so, that's what makes it interesting.
It does. I mean, I will add one thought onto that very good diversion, which is that while I am probably less of a yield-bearing payment stablecoins will cause deposits to just flee the banking system. Like, I think that's a pretty big overstatement on the part of people who make that argument. I will say that the flip side to it that is really important and that I think is under-discussed, but it goes to that like privileges and responsibility of what we call a bank holistically. I find folks in the crypto stablecoin space to be wildly dismissive of the benefits to society of fractional reserve banking. And obviously, like this narrow versus fractional thing has been a debate for like a long, long time. It's going to be a debate forever. But it is interesting to me. Again, we were in a room full of bankers in North Dakota. And when you talk to those bankers about net interest margin and, deposit betas and things like that, they almost look at you like you've lost your mind a little bit because they're like, look, my job is to have deposits and then to loan those deposits to farmers who live in my community who need them to grow food for all of us to eat. And it's like a very simple, very direct, and very like kind of community social good oriented way of thinking about the business, even though they have the same business model and functionally the same incentives as any other bank has. And I find that view, I wish I could like grab crypto and stablecoin people and put them in that room and let them talk to those folks. Because I think like fractional reserve banking feels like a scam when you look at it just like on a balance sheet. It's like, why are banks not paying out, higher yields on this deposits? This is insane. And when you don't see the other side of what that system provides, it's the Chesterton's fence thing where it's like, let's just knock down this fence. Why is this here? And I do find that that nuance missing in a lot of these debates where it's like, to your point, the things we've historically kind of bundled as a bank have a lot of reasons for existing, not all of which might not be totally visible to you at this moment. This episode is brought to you by Persona. Every fintech founder hits the same wall. You need to verify users, but off-the-shelf solutions aren't built for how your product works. Persona is the identity verification platform that puts you in control of your flows, with the automation and scalability to take you from your first 100 users to your first 1 million without replatforming. There's a reason that companies from YC-backed startups to publicly traded fintechs run on Persona. And right now, Fintech Takes listeners can claim a free full year through Persona's startup program at withpersona.com/FTT.
It's ignorance of how kind of the banking system and the monetary system work together for the economy. Like
Totally.
Anyone who goes through kind of banking 101, like understands like that's how it works. Like that's how economies can grow. You can't have an economy grow without fractional reserve banking or that kind of credit and credit intermediation, liquidity intermediation. I find this, there's a little bit of a cultural element to this where, like I saw this a bit back in 08, pre-08, where trading culture and banking culture were two different cultures. Like traders would say, we're in moving, not storage. That's what we do. We trade, we buy low, we sell high, we move stuff. And bankers are like, we're in storage. We take deposits, we make loans, we sit on it. And when you blended those things together, you had two very different vocabularies, very different mindsets about risk, and two very different understandings of history, right? Because to the trader, liquidity is a really big deal. And to the banker, credit losses are a really big deal. And
Right.
But the other thing seems like, why are they so worried about that? And you put those things together, and it's like, oof, that's a problem. And now I think it's more technologist to banker. I think the technologists are like, hey, we're good technologists. We can engineer all sorts of solutions to things.
Sure. Yeah.
Not realizing that like trust is this funny thing in banking and finance, and you can't engineer your way to that, at least not directly. And so you get some of these conversations which feel like they're happening on two different levels, as you pointed out. It'd be nice if you could kind of bring them together.
I'd like to. I mean, maybe we should all meet in Fargo and just hash this out together as a big group. I do, I'm sure Bank of North Dakota would be happy to host us. I do think that actually brings us to the next chapter in the story that I want to talk about, because talking about technologists and sort of techno-libertarians having a very different vocabulary and philosophy, that brings us to Satoshi Nakamoto and a white paper that he wrote. Give us the quick 411 on, obviously this. I'm sure a lot of people listening are familiar at a high level. I'm not sure everyone's read the white paper. You pointed this out actually in your talk, that
everyone
should. It's not that long and it's pretty interesting. So everyone
it's a great paper.
Should read it for sure, because it does outline both things that sort of are the foundation of everything we're talking about now with stablecoins, but also I think illustrates how what we're talking about with stablecoins has maybe drifted from it in interesting ways. So talk through that.
So I think the most salient fact is when. When does this paper come out? It comes out in January of 2009. So this is peak crisis. This is, Lehman Brothers has failed. TARP has gone, there's great uncertainty. The stress test hasn't been done yet. So it's peak uncertainty, and the white paper comes out, and in the Genesis block of the Bitcoin blockchain, Nakamoto inscribes the headline of the paper. This is, Chancellor on the brink of a second bailout for banks. So this thing is coming directly from a frustration with the traditional banking system and the governments, and saying like, you guys screwed up. And I think that's why it has so much traction, because everyone did screw up. The bank screwed up, the government screwed up. Like, why did that happen? And there's this great frustration in saying, I have a better answer. Like I think this why this paper has had so much resonance over time, is to say, this traditional system has let us all down in all the sorts of ways, and this is a better way. And what's interesting about the paper, it is very short. It's like 7 pages. It's a very elegant paper. It's parsimonious. It's on point, but it describes a peer-to-peer payment system without relying on a trusted intermediary. No banks, no governments. How do I, Mike Hsu, pay you, Alex Johnson, without any intermediary? And we can do this, no double spend problem. We're just going to use cryptography and this thing called a blockchain. It's pretty, like, I remember when I first read it, I'm like, this is really interesting. This is kind of cool. The problem is it doesn't scale. Like it's great as a paper. It's some fantastic, really cool ideas. It pulls every emotional heartstring and every kind of policy string to say this is a better way, but it just doesn't scale. It doesn't scale, not in the way it was kind of conceived. And it doesn't meet reality, which is that people have to transact. They have to buy things, they have to spend money, they have to save, they have to do all sorts of things in a local currency. And so there's no, I guess you could snap your fingers and go to a future in Bitcoin, but that's not realistic. And so you've had all these kinds of ups and downs with it. And I think it kind of eventually had to lead to stablecoins because Bitcoin by itself is not a medium of exchange. You can't use it to buy stuff, certainly not at scale. But a lot of those feelings have persisted.
Yeah.
For good reason. And I think as a regulator, to me, it's a really good reminder, like, this is why we have to do our jobs well.
Right. Like
you want a good banking system and regulation so that people shouldn't have to dream up something like that. They should be able to trust this. And if you fail from time to time, that's what happens.
No, it's a great reminder. And it's funny because kind of speaking to that point of like, we all carry this like genetic memory that kind of gets handed down from previous banking crises. You know, I remember when Coinbase was making all their very loud arguments around the yield debate with stablecoins, what did they call? They called the elimination of the loophole in the Genius Act, which they were going to address through clarity, a bailout for banks. And I remember when I read that, I was like, I don't think you're using those words correctly, but at the same time, I can also see very clearly the emotion that you're trying to tap into. And it's interesting because that emotion persists today. It's fascinating because banks are still cast oftentimes in these discussions and debates as like the bad guys, which I think is very much a legacy of 2008. And the divergence between the emotional resonance of the idea and the practical implications of it, it's really interesting to watch people fight about it, right? And I'll give an example. You see lots of people who are building in stablecoins or building in blockchain, but with like payments use cases, very practical use cases. And they started off by saying, okay, like, and this is like the Jack Dorsey one, like, yes, we have Bitcoin. Now we're going to do an L2 on top of the blockchain Lightning that'll allow payments to work better. And it kind of works, but it also kind of doesn't. And then like you have Ethereum and it's for DeFi and smart contracts and everything. But now we're going to build these layer 2 applications on top of Ethereum that work better and are better for payments. But again, like kind of, but you're just kind of getting the worst of both worlds in a sense. So it's not really good. Then you start to see the development of like new layer 1 blockchains.
Yes.
And the layer 1s are fascinating because to me, when I watch them get developed and rolled out, it's like payments people like LARPing as Bitcoin people, where they're like, decentralization, this is great. All of these different, validators and nodes, and we'll have this big network and it'll be decentralized. But like quietly, they're like, but it won't be that decentralized because we need it to work for payments. And the transactions that we make are reversible. They're not irreversible because people like the ability to have chargebacks. And so it's like, it's been really fascinating to watch crypto and stablecoins become much more like banking and payments because they have to functionally. Yes. But that requires a transition away from the philosophical and architectural principles that Nakamoto outlined in the white paper and that Bitcoin like hardliners still firmly believe in. But as that transition is happening, everyone is sort of using the language of decentralization to make that transition like less scary or painful to people who they're building for in that ecosystem. It's really interesting to watch from an outside perspective.
So I think the bookend piece to read would be Circle's ARC light paper. So Circle's L1 is ARC, and they put out a white paper, I think they call it a light paper, explaining why they built ARC. And ARC is exactly as you described. It's an L1 built for payments. But in describing that, they describe all of the frailties and the unscalability of the existing solutions, including all the Ethereum-based stuff. Because Ethereum, it turns out, the reason it doesn't scale is because the more you use it, the more you get congestion. The more congestion, the higher the gas fees. And the gas fees are in Ethereum. So the whole thing just doesn't work. So they identify it and they say, and here's a better solution. And so in a way, you've kind of come full circle. And I like to reference the 5 stages of grief all the time. Yeah. And I think I remember when crypto was ascendant, a lot of the crypto folks were coming into the OCC and saying, like, you guys are in denial. Like, the future is digital. You guys are analog. You're going through the 5 stages of grief. And I think here it's now flipped around. I think for payments, the stablecoin space has come around and realized that, like, you need throughput, you need speed, you need reversibility, you need certainty about all these things. And you can design that. But in order to do that, you have to let go of decentralization. You have to let go of some of the more emotionally foundational pieces of Nakamoto's piece. And I think that's tough. I think that you see these debates in the crypto industry, that there's a little bit of tension between these communities. But it's, at some point, practicality, there are those who are a bit more practically oriented, who are like, okay, but we got to build to where the consumer is and to where the market is. And that's the direction.
No, totally. One, we haven't even talked about BSA AML, but that's another one where it's like, philosophically, my belief as a Bitcoiner is I have a right to privacy. That privacy is enshrined in code. That code is controlled by a wallet that sits on a device that's on my shelf. And never should I have any compromises with that experience. And that's just, you say those words out loud in that order to someone who works at FinCEN, and they're like, yeah, no, not how the world works. Sorry. And it's just like not on a deep level, not compatible. So I think you're right. Like, seeing these things smash into each other has been educational. And that brings us to, I think, maybe the most interesting and forgotten historical chapter in stablecoins. Partially because it just happened, it's not that long ago that we just did this, which is Facebook trying to launch Libra/Diem.
Yes.
Mike, you were a regulator when this happened. You were amongst central bankers a lot. Like, paint a picture of what happened for maybe folks who are listening who kind of missed this or weren't paying attention at the time, and how it rippled through the broader kind of policy world and the impact it had.
So this is, I think, June-ish of 2019. So you're right. This is not that long ago. This is not 1863, not. Right?
Like, my son was alive. My eldest son was alive, and he's 8. So really not that long ago.
So it's 2019.
Mm-hmm.
And out of the blue, I think it literally was out of the blue, Facebook says, we're going to launch this cryptocurrency called Libra, and it's going to be linked to a basket of currencies. And you can totally see where Zuckerberg is coming from, because Facebook at this point has over 1 billion users globally. This is not like a college dorm room social. This is a global platform with 1 billion users who are using it all the time. And there is commerce on it now. People are buying and selling stuff, right? They're starting to eat into Craigslist. And the idea is like, hey, we've brought the world community together on the social platform. Why not have a currency that we issue that can kind of facilitate that? So you can see the technologist's dream framed that way. And to central banks everywhere, it was a black ship moment. Gillian Tett talks about like the black ships from Commodore Perry floating into Tokyo Bay at the end of the Tokugawa period, and the Japanese being like, oh my God, we isolated ourselves for too long and the world passed us by, and we have to snap out of it. And that was the central bank reaction, was like, oh my God, like, this has the capacity to completely bypass all monetary authorities at scale immediately. And everyone was confronted with it at the exact same time. Like, it happened in one country and you had to go to conferences. It happened and the second central bankers got together to talk about it. Everyone's talking about, like, what are we going to do about this? And what's this world look like? It was a wake up call. And to me, what's really interesting is Facebook then makes a number of adjustments.
Right.
It wasn't just rebranding it as Diem. They said, oh, okay, if you're worried about a basket, we'll do it to one currency. Oh, if you're worried about BSA, we'll make it, a closed loop. And so they made all these accommodations to make it more amenable and compliant for regulators. But I think the initial shock and the realization that this is what could be the case, it was just too much for central bankers to get over in terms of getting comfortable with.
Well, I totally agree. And if there's some really great kind of retrospectives that have been written by folks who worked on the project at the time that folks should go read, because they sort of illustrate, like, with the benefit of hindsight, these are the missteps that we made. And I guess the two questions I have based on this chapter of the story are, one, what did kind of crypto stablecoin folks learn about how to introduce an idea like this, and like how not to surprise policymakers when it comes to things that like touch central banks and the supremacy of currency in different regions? And then the second part of the question is, what maybe did like policymakers learn about this stuff? Because it's funny comparing the way central bankers reacted back then to it to, again, this wasn't that long ago, to now, where the response from policymakers is, much, much more open, accommodating, accepting of technological change. So like, what's your perspective on how each side kind of learned from that experience?
So I think it's interesting, like on the issuer side, I think there's two lessons you can take from the Facebook.
Sure.
And I think you see this kind of borne out. One lesson would be they shouldn't have asked for permission. They should have just done it. Right? Like,
it's very old-fashioned, the whole asking for permission thing. Yeah.
Yeah. I mean, I think, one could arguably say like that's been Tether's strategy. Tether's like, we're not going to ask for permission. We're just going to do it.
Absolutely.
And if people use it, and we'll deal with it later.
And if we get big enough, people will have to deal with us, right? Yeah.
Yeah. So that's, I think, one lesson was like, they shouldn't have asked. They should have just done it. And then the other strategy is like, no. You got to go slow. You got to you got to meet the regulators where they are. You have to speak their language. You want that will be the business model. And I think Circle is kind of taking that path. And there's, strategies in between. And that's, I think, how that experience kind of got probably indirectly embedded within different strategies and thinking.
That's really, I had never thought of like Tether and Circle as the spiritual twins that diverge down two different paths, being born from Libre Diem. But that makes a lot of sense, because like it's two different models for how to do it. And ironically, we ended up with a market where those are the two biggest stable coins. And I mean, people can read into what it means that Tether has sort of been beating up on Circle in terms of growth and market share and stuff, that maybe one model works better than the other. The story's not over, obviously, but it's been fascinating. How about from a policymaker perspective?
Well, it's surprise. Policymakers don't like to be surprised,
right?
And they don't deal with surprise very well. And there will be an adjustment. Folks always adjust, but I think after getting over the initial shock, a lot of policymakers said, like, we got to get smart on this stuff. Like, what is this thing? What are the pros and cons of it? How do we think about it? And that takes some time. And I think once you get that time, you can have a much more rational discussion. And that, I guess the lesson there is that kind of springing surprises on regulators is not, it's not going to end well usually.
Right. Well, and I think to your point, like, I think what I noticed among regulators, and it's more just over that time period generally, is we have to proactively work to get smarter on stuff, because technology moves without us, right? Like, technology doesn't always check with you. Technology doesn't always evolve. It's not like Satoshi Nakamoto mailed a copy of his white paper to the Fed before he published it, right? Like these things happen in parallel to what we do, but they don't always cross over. And so getting ahead of it makes a lot of sense. All right. That brings us roughly to our current time frame. You obviously mentioned the crypto crash of 2022. Which was kind of the clearing out of the wildcat banking version of stablecoins. Obviously, Terra Luna being the thing that kicked all of that off. I guess the way I would characterize that is that we had a swing from, whoa, really dangerous, like, please be careful. back to the other end of the continuum, and obviously there's an undercurrent of politics and money in politics that drives a lot of this, but a swing back to the other end of the continuum, which is we want to embrace this. You hear a lot of people talk now from a policymaker perspective with like genius and clarity as we want to lead the world in this. We want to onshore this. Like we want this to be here. I guess my question for you to wrap up is sort of taking lessons from all of the things that we've talked about over, gosh, we've covered a couple centuries there, roughly. That was a lot of time to go through. What would you say is sort of your read on kind of where we are right now in that pendulum swinging back and forth?
Yeah.
Of like what folks should kind of take away as lessons from all of this in terms of what might happen next or how to proceed?
So in a way, the lessons end up being a little bit self-correcting. So Genius did try to solve for this. When you have 1,000 flowers bloom, can you create a stable equilibrium when you have 1,000 flowers bloom?
Right.
So that's, I think, the glass half full read on Genius is that, look, they're not trying to make one stable coin that rules them all. That would have been the CBDC. Rejection
which
of
we're
that,
not doing. Yep.
Which we're not doing. And so if you say, well, if there's going to be a bunch of these, can we create a structure that enables that would be stable over time? And this is the experiment. And I think this experiment actually takes a bunch of lessons from the past and is trying to craft a new way forward. I don't know if it's going to work. I think the financial historians would say, nothing new under the sun. This will fail too. This will, in the same way that money funds are trying to like thread this needle. And in stress, you can't thread the needle. Either it's money or it's an investment. And that's what's going to happen here as well. I think there are some folks who believe that, but others are like, no, we're capable. We're capable of creating new solutions and new possibilities. I'm in the middle. Like I think I'm naturally skeptical because I've got all the regulatory DNA. I have been spending more time with builders, and I do want to hold out hope that we can build things that will create more opportunities. But I think we have to be careful about that. I think it's very easy to kind of push beyond that and get out over your skis. And there's two things like looking ahead that just make me a little, it's not nervous, but I think there are things to watch. One is that you've got stablecoins and AI, like the nexus with AI. And there's this really interesting book called Boom by Hobart and Huber. And
I've read that, yeah.
It like makes a positive case for booms.
For bubbles,
right?
yeah.
It's for bubbles, right? And saying like booms and bubbles are good because you get these huge advances. You have a lot of destruction and chaos, but you get these huge advances that otherwise would never happen. And they cite some booms that happen that are couplets. They're like too many booms that happen side by side, and they reinforce each other.
Oh,
so
yeah.
Semiconductors and software, I think is like the classic. Fiber optic cable and internet. Like the more fiber optic you have, the more internet. The more internet, the more fiber optic. And these things kind of feed each other. There's an argument that stablecoins and AI are that the more AI you have, these agents have to pay each other at some point. How are they going to pay each other? And I know there's a lot of experiments going around with like, ramp card and these other things.
Yeah.
There's one argument that like stablecoins is the most efficient way to do it because it's just wallet to wallet. And do these two things kind of enable each other in a way that otherwise each on their own can't do? Question mark, right? And if that happens, that will go fast. That will be a fast thing because we know AI is just very fast. And then the other thing that I do worry about is the nexus with treasury securities. Because this was cited as a benefit of stablecoins that they have to buy all of these treasuries. Easy come, easy go. There's no free lunch. And if this is kind of a new demand source for treasuries, well, that demand source can go away. And when you've got $40 trillion of treasury debt to service, like I don't know if I'm really worried about that, especially in kind of the current global environment, that's not a healthy feature.
Yeah, no, that makes sense. I will add one additional one to the potential areas of concern. And I think banks are starting to wake up to this, although it took them a while, which is stablecoins and Genius, stablecoins, safe, hopefully well-regulated, well-supervised, still on-chain. on-chain is an equally easy interoperable bridge over to DeFi and things that are wildly unsafe and dangerous. And this kind of gets to like, yeah, I have a checking account, but my checking account is natively integrated with the most bespoke and risky and strange investment opportunities available in the world, all with the click of a button. And so, a lot of these things, they both rhyme, and then technology introduces new challenges that we have to adapt to. Mike, I will let you go. Thank you so much. This was how I would have totally distracted the room in North Dakota if I'd been allowed to just ask you all the questions I had. So thanks for humoring me and coming on. This was awesome.
This was a lot of fun. Thanks a lot, Alex.
Thank you. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.